When financial experts start talking about the yield curve, most people's eyes glaze over. It sounds technical, abstract, disconnected from daily life. But that curve, the simple relationship between short-term and long-term interest rates, has quietly predicted every U.S. recession for the last 50 years. Not some, not most, every single one. It flashed red before the Great Depression in 1929. It inverted again before the financial crisis in 2008. And now, in 2025, it's screaming louder than ever. Every time this pattern appeared, the same thing followed: a collapse. What makes this moment terrifying isn't just that the yield curve has inverted again, it's that this inversion is deeper and longer lasting than anything seen in living memory. The gap between 2-year and 10-year Treasury yields has plunged below 1%, a level that has never failed to precede an economic disaster. And yet, almost no one is listening. The stock market is euphoric, unemployment is low, and the media keeps calling it a soft landing. But the data tells another story, one written in blood-red numbers and ignored warnings. Because the yield curve isn't a theory, it's a mirror, reflecting exactly how much the future is worth. And, right now, that mirror is showing us something chilling: the end of the illusion. To understand why investors are terrified, you first have to understand what the yield curve really means. It's not just a chart, it's the pulse of the global economy. Each point on that curve represents how much interest investors demand to lend money for different lengths of time. Normally, long-term bonds pay higher yields than short-term ones, because lending money for 10 or 30 years carries more risk than lending it for 3 months or 2 years. But when that relationship flips, when short-term interest rates rise above long-term rates, it means the financial system has lost confidence in the future. Investors are so afraid of what's coming that they rush to buy long-term bonds, even if it means earning less. They're not chasing profit anymore, they're seeking safety. That reversal is called a yield curve inversion, and it has never happened by accident. It's a sign of deep fear and structural stress. The pattern is brutally consistent. In 1928, the yield curve inverted months before the Great Depression began. In 2006, it inverted again before the 2008 financial collapse. Each time, policymakers downplayed the signal. They said, "This time is different." Each time, they were wrong. Why does it matter so much? Because an inverted yield curve destroys the basic engine of lending. Banks borrow money short-term and lend it long-term. When short-term rates are higher, that business model stops working. Lending dries up. Businesses can't expand. Households can't borrow. Jobs disappear. It's a chain reaction that starts quietly and ends violently. Right now, that same pattern is back, and it's worse than before. The spread between 2-year and 10-year U.S. Treasury yields has collapsed to levels not seen since the early 1980s. It's not a blip or a technical anomaly. It's a blaring siren that the market no longer trusts the story being told by governments, central banks, or corporations. Every inversion whispers the same truth: the cost of money has become unbearable, and growth is an illusion. The longer it stays inverted, the louder that truth becomes. And today, the sound is deafening. The yield curve doesn't predict the future, it measures faith in it. And, right now, faith is vanishing. If you look back through history, the pattern is impossible to miss. Every time the yield curve inverted, disaster followed, not immediately, but inevitably. It happened in 1929, it happened in 2008, and the same forces are aligning again in 2025. The names change, the markets evolve, but the underlying behavior never does. In 1928, the Federal Reserve tried to slow down an overheated market by raising interest rates. It was a desperate attempt to cool speculation that had spiraled out of control. Across America, ordinary citizens, factory workers, farmers, even small-town shop owners were borrowing money to buy stocks on margin. They believed the boom would never end. "Everyone can be rich," the newspapers said. "A new era of prosperity has begun." But the yield curve inversion that followed was a warning the system ignored. Credit was tightening while speculation exploded. The financial world had entered the danger zone, where the cost of borrowing short-term became higher than the rewards of lending long-term. In plain English, that meant fear was winning over greed. Within 18 months, the illusion shattered. Black Tuesday. The market fell 90%. Banks failed, businesses vanished, and the Great Depression began. Fast forward nearly 80 years to 2006. The Federal Reserve, again fearing inflation, raised rates. The yield curve inverted once more. Economists noticed, but Wall Street laughed it off. This was the age of financial engineering, of credit default swaps, of subprime mortgages sliced, packaged, and sold as safe investments. They said it was different this time. That risk had been diversified out of existence. But in reality, it had just been hidden. 2 years later, Lehman Brothers collapsed. The global financial system froze, and millions lost their homes, jobs, and life savings. The same script had played out. Cheap money had created artificial prosperity, and the yield curve had warned of the coming crash long before anyone was willing to listen. Now, in 2025, the echoes are unmistakable. The inversion that began in 2022 has become the longest and deepest in modern history. Governments are drowning in record debt. Consumers are maxed out on credit cards and loans. Corporations are addicted to cheap financing that no longer exists. The conditions are eerily familiar, and the complacency is exactly the same. In 1929, investors ignored the curve because America was unstoppable. In 2008, they ignored it because housing never goes down. In 2025, they're ignoring it because technology will save us. But numbers don't care about optimism. The yield curve doesn't lie. It measures reality stripped of emotion, and that reality says the system is cracking again. Each generation faces the same choice. Believe the comforting story or believe the data, and history shows what happens to those who choose wrong. In 1929, debt was dangerous but containable. In 2008, it was catastrophic but still fixable. In 2025, it's beyond control. What we're witnessing now isn't just another credit bubble, it's the peak of a debt supercycle nearly a century in the making. For decades, every economic slowdown was met with the same cure: borrow more. Every crisis was solved by creating new debt to paper over the old one. But eventually, the numbers stop adding up. Eventually, the future runs out of credit. Today, the U.S. national debt has surpassed $38 trillion, growing by about $1 trillion every 100 days. That's not hyperbole, it's math. The federal government now spends more on interest payments than on defense or education. Corporate debt has exploded past $12 trillion, much of it rated just above junk. Household debt, from credit cards to car loans to student loans, is at all-time highs. Families aren't just borrowing to live better, they're borrowing to survive. In the 20th century, debt was mostly domestic. Now it's global, digital, and instantaneous. Private equity, hedge funds, and shadow banks borrow through complex derivatives that even regulators struggle to map. Cryptocurrency exchanges leverage digital assets at insane ratios, creating new forms of synthetic debt with no collateral. Everything is connected, and that's the problem. When one pillar falls, the entire structure shakes. The yield curve inversion that began in 2022 didn't just warn about a slowdown, it revealed that the entire global economy had become dependent on permanent borrowing. Cheap money created an illusion of stability. Governments spent without restraint. Companies that should have failed years ago survived on zero-interest loans. Consumers mistook credit for income. It wasn't growth. It was a Ponzi scheme with national flags. And now the bill is due. The Federal Reserve can't slash rates without reigniting inflation. It can't print money without devaluing the dollar. It can't raise rates further without triggering a cascade of defaults. Every lever that once worked now pulls in the opposite direction. Policymakers are trapped, damned if they intervene, doomed if they don't. This is the final stage of a debt supercycle, when borrowing no longer stimulates but suffocates. It's when nations can't afford to grow because the cost of servicing old promises outweighs the benefit of making new ones. It's when an entire civilization quietly realizes that it has spent the future. In 1929, they called it over-leverage. In 2008, it was toxic assets. In 2025, it's normal life. Every paycheck, every company, every government budget, all built on debt that can never be repaid. The yield curve isn't warning of an upcoming crash anymore. It's describing the one we're already in. The supercycle doesn't end with a bang. It ends when people stop believing the next bailout will work. And that moment is coming. For nearly a century, every crisis has been met with the same answer: cut interest rates, print money, and pretend control still exists. It worked in 1987, it worked in 2008, and it worked again in 2020. But each rescue came at a cost. The next crisis had to be even bigger to justify the next bailout. Now, in 2025, that cycle is over. The tools are spent. The illusion of control is dead. The Federal Reserve's balance sheet has swollen past $8 trillion, more than double its size before the pandemic. Global central banks, from the European Central Bank to the Bank of Japan, hold so much debt that they've become prisoners of their own policies. They can't raise rates without bankrupting governments, and they can't print more money without igniting inflation. The medicine has become the poison. For decades, the world believed that monetary policy could outsmart human nature, that debt could replace discipline, that manipulation could replace productivity. Low interest rates became the new opiate, quantitative easing became the new religion, and the yield curve, once a warning, became a casualty, distorted, flattened, inverted by endless intervention. But numbers don't lie. Every economy reaches a point where it can't be stimulated anymore, where the cost of maintaining the illusion exceeds the benefit of pretending it's real. That's where we are now. Interest rates are already high enough to choke small businesses, yet still too low to tame inflation. Government deficits are growing even during supposed booms. And corporate zombies, companies that can't survive without constant borrowing, now make up nearly 20% of the market. This is no longer capitalism. It's a system on life support, kept alive by policies that only delay the inevitable. The price of money, the foundation of every market on Earth, has become political, not economic. And when money loses meaning, everything built on it begins to rot. In 2008, printing money saved the system. In 2020, it saved the illusion. In 2025, it can't save either. Every new dollar created to fix the problem only devalues the ones that already exist. Every bailout breeds the next bubble. Every stimulus buys time and sells the future. The yield curve's inversion is no longer just a signal of what's coming. It's a confession. It's the financial system admitting in plain sight that the game is over, that growth is an illusion, stability a myth, and soft landings a fantasy. The system doesn't need another rescue plan. It needs an autopsy. And what's coming next isn't just a correction, it's a reckoning. Every financial collapse begins in one country, but never ends there. The United States might be the heart of the system, but the blood, the dollars, flow everywhere. When the Federal Reserve moves, the entire world trembles. And in 2025, those tremors are turning into earthquakes. For years, emerging markets borrowed heavily in US dollars. It made sense when rates were near zero. The money was cheap, plentiful, and seemingly endless. Nations from Turkey to Brazil, from South Africa to Thailand, loaded up on dollar-denominated debt to build infrastructure, fund subsidies, and stabilize their currencies. But that cheap money era is gone. As the Fed raised rates to fight inflation, the dollar surged in value, and those debts suddenly became impossible to repay. Now the same countries that once thrived on foreign capital are being crushed by it. When their currencies fall, imports skyrocket, inflation explodes, and governments print even more of their own money to survive, accelerating the spiral. What began as an American policy decision becomes a global credit squeeze. The yield curve inversion isn't just a US problem, it's a reflection of global fragility. Every major economy is chained to the same debt-driven model. In Europe, bond markets are breaking under the weight of energy subsidies and war spending. In China, real estate defaults are metastasizing through shadow banks. In Japan, decades of zero rates have created a time bomb of unsustainable debt that can never be unwound. Each nation faces the same dilemma: raise rates and risk collapse, or print money and risk hyperinflation. There's no middle ground left. The dollar's strength now acts like a wrecking ball, swinging across continents, demolishing weaker economies in its path. What makes this cycle unique is speed. In 1929, it took months for contagion to spread. In 2008, it took days. In 2025, it takes seconds. Because markets are now digital and algorithmic, panic no longer travels through banks or newspapers. It travels through code. One failed bond auction in Europe triggers a sell-off in Asia. A crypto crash in Singapore wipes out liquidity in New York. A margin call in London cascades into defaults in Africa. The dominoes don't fall one by one anymore. They all collapse at once. This is the reality of a world where every nation borrows from the same pool, trades in the same currency, and bets on the same illusion of endless growth. When the first pillar breaks, no one is safe, and the yield curve, flatlined for months, is already telling us which direction those dominoes will fall. Every crash begins with numbers, but it ends with people. The real collapse doesn't happen on trading floors. It happens in living rooms, in small businesses, in paychecks that no longer stretch to the end of the month. The yield curve inversion isn't just a chart, it's a warning that faith itself is running out. For decades, the world believed in a lie: that money printing creates prosperity, that debt creates growth, and that central banks can save us from the consequences of our own excess. But in 2025, the truth can no longer be hidden behind spreadsheets and sound bites. The system has reached its final contradiction. The very tools that once postponed collapse now accelerate it. Rate cuts no longer revive growth. Stimulus checks no longer calm fear. Bailouts no longer restore confidence. The illusion is breaking, and with it, the foundation of modern life, the belief that working, saving, and investing guarantees safety. The next collapse won't just be financial, it will be psychological. It will strip away the last layer of trust holding society together. Governments will lose credibility, markets will lose liquidity, currencies will lose meaning, and ordinary people, the savers, the workers, the believers, will wake up to realize that the future they were promised no longer exists. The yield curve, for decades, has been the quiet prophet of these moments, a mathematical truth that no one wants to believe. Doesn't predict the end of the world. It predicts the end of denial. When the final inversion unwinds and the last domino falls, there won't be panic at first, just silence. The same silence that always follows when an empire realizes it has run out of time. Because this isn't just another cycle, it's the reckoning, the moment when reality calls in every debt we've refused to pay. In the end, the yield curve isn't just a financial instrument, it's a truth detector. It cuts through optimism, through politics, through the comfortable lies that keep people calm. Every time it inverts, the same story unfolds: denial, panic, collapse, recovery, and forgetfulness. Humanity learns the lesson, then forgets it the moment markets rise again. In 1929, it warned of greed. In 2008, it warned of deception. In 2025, it's warning of exhaustion, a system stretched so far beyond logic that even the numbers are breaking. And still, most refuse to see it. The experts will keep talking about soft landings. The media will call it temporary. The politicians will promise stability. But when confidence dies, no speech can resurrect it, because no government can print trust, and no central bank can manufacture faith. The yield curve doesn't lie. It never has. It simply waits, silent, patient, inevitable, until the cycle completes itself once again. And when the crash comes, history will say we were warned, not by prophets or politicians, but by the curve that saw it coming every time. Fade to black.